Pfizer is down over 50% year over year, and right now it's sitting at the point where it's returning a 6% dividend yield. So today we will be looking at it and seeing whether this is a possible value trap or whether this can yield high returns for the investor, because we believe that right now it is sitting at very attractive pricing. However, we have detected some deteriorating fundamentals which could actually hinder its performance in the long term. So Pfizer, a pharmaceutical leader. Pfizer focuses on the discovery, development, manufacturing, marketing, sales, and distribution of their biopharmaceutical products worldwide. So they are extremely vertically integrated and they can do all these functions at the same time. The company is divided into 3 sections for easier management. The first one being primary care, the second one being specialty care, and the third one being oncology. For the long term, it's focusing on 3 different things for their research and development priorities, which are essential for a pharma company. First one is delivering a pipeline of highly differentiated medicines and vaccines, which is the main focus for pharma because this is the way that they develop new products and can give new offerings to the markets. Then they are advancing their capabilities, so the way they manufacture the vaccines, the way they're able to distribute them, and everything like that. And the third one is advancing their new models for partnerships to improve innovation. This basically means working with other companies, such as how they did with BioNTech, I believe it was, for the COVID-19 vaccine. So this year in 2022, they actually did 3 acquisitions, and in 2023 they have done others. They acquired Arena, GBT, and Biohaven in 2022, and this shows us that this company right now is using acquisitions as a way of growing the revenues, which I am not a huge fan of because this year they did a very big acquisition in purchasing Seagen, another pharma company. But we will analyze and see whether this can be a problem for them in the future. So this is the financial analysis for 2022. They had a very good return on capital employed of 18%. This is generally around 10, so whatever that is higher than that is a lot better. Had an interest cover of 29 times and a cash conversion of 94%. With the interest cover, this means that they have very low liability risk, and with the cash conversion, it means that they are very good at converting any income they actually get into free cash flows. And this is very weird because this company conducts a lot of acquisitions, and acquisitions usually hurt a company's free cash flow. So seeing this in 2022 was a very good indicator. Now their profit margin was 62% and their operating margin was 35% or around there, which is honestly insane for a pharma company of that size. So this was great to see in 2022 and would have been extremely attractive for all kinds of investors. However, up until now, there have been certain developments that have affected their price and these metrics which have made it become more undervalued, the price to drop, and for it to become trending as it is right now. You can see that from December 2022 all the way up to October 2023, all their financial metrics have actually deteriorated. You can see that their revenue has gone down significantly, that their gross profit has also decreased, and their net income has shrunk considerably. Adding to this, just look at the decrease in their gross margins in the previous 2 or 3 quarters. It's incredible. The margin is down 49% year over year and 44% from the previous quarter. This should be a red flag for all investors, and if Pfizer doesn't manage to get this under control, this could be a huge red flag moving on into the future. Additionally, you can see here all the different metrics such as return on equity, return on assets, return on sales, and return on invested capital. They were all around 30% or the return on assets sitting at around 15% in April 2023. And since then, they have all shrunk as well, going as low as from 15% all the way up to 5% for the return on assets. And this is what's very worrying about Pfizer, because if they don't manage to get this under control and get them back to the levels where they were previously, for me and for a lot of other investors, this is not attractive and this is a huge no-no for Pfizer stock. When conducting a fundamental analysis over them, we can see that they do have very solid points. For example, they have low liability risk still, and they have a pretty solid balance sheet. They still conduct dividends, which, considering the state the company is in, I'm not sure if this is healthy for them or it's actually hurting their performance even more. And they have an existing moat or competitive advantage, with their pricing power, which comes from the patents of the medicines they have. However, they have a huge problem with cash flow consistency, which derives from their strategy of being very acquisition growth focused. And this is also very bad since they are not able to grow their free cash flows or revenues organically. They have to resort to acquisitions, which is not something I like to see in the companies that I like to invest in. Their valuation, however, does look extremely attractive. Look at their PE ratio. All the way since September 2020, it has gone down considerably. It was a lot lower in April 2023, but right now it's also trending downwards, sitting at a current PE ratio of around 14, which is a very attractive price for Pfizer. And adding to this, the free cash flow yield is at a 5.5% free cash flow yield, which is a lot higher than the long-term inflation rate of 3%. And this is a metric that Terry Smith used to like a lot to value his companies. He says that as long as the free cash flow yield is higher than the long-term inflation rate and the company is growing, this should be an attractive valuation for any company. So according to this, Pfizer is at an attractive price right now. Now, the risks and possible challenges. For competitors, I don't believe this is a huge risk because there is a worsening competitive landscape, but in pharma, it all depends on what patents you have and how good you are at research and development for these medicines. In terms of regulatory and performance, these are the two risks that worry me the most, especially the performance one. The regulatory is that these companies are very dependent on regulations since they have patents and the FDA kind of controls their offerings. In terms of performance, we have seen that this has been very troubling, especially because the COVID-19 products that they used to offer have been decreasing in demand a lot, and their growth projections for them have been reduced year after year, quarter after quarter. Finally, the market, since it's pharma, I don't believe they are heavily affected by the market, since people will need medicines whether we are in an economic downturn or not. So before we move on to the investment conclusion, just remember, I'm not a financial advisor and this is not financial advice. You can do whatever you want. Do your due diligence before actually investing in anything. I'm just here to do these videos for myself, to force myself to do a proper due diligence on the companies I'm presenting to you guys. But having said that, first of all, they do have a moat, a very big moat, and which gives them a competitive advantage. And this is done through not only their patents, but Pfizer has such a good and recognizable brand that they are able to gain the trust from the consumer in a way easier way than the other pharma companies. However, they do not have consistent cash flows, and this company is not predictable and not resilient with their cash flows, and they do not have a high return on capital employed anymore, meaning that currently they are not creating value for the investor, but they are instead destroying value for the investor. Having said that, I believe that this is a risky company. However, at the valuation that they are currently sitting in, I believe this could be a turnaround play, meaning that they may generate high returns. However, it has a high risk that I, as an individual investor, am not willing to undertake. So this has been the Cash Flow Compounder as always. Thank you for watching. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.